This is a download from BFM 89.9, the business station.
As the S&P 500 heads for its longest rally since 1998, Dodge, is there a fear of a summer lull as we head into the third quarter of the year?
Good morning, Nadia. Not a fear exactly. In fact, a lull would be good given where we are in the season. An abundance of new highs in our major price indices during June have been accompanied by a still very modest list of classic warning signals of a major market top. The current evidence continues to confirm the bull market is still underway. And based on our history, we are favoring at least another 4 to 6 months of further gains, possibly longer, before the final highs. But it is too early to adopt a heavily defensive strategy. But we are seeing it's becoming gradually more difficult for investors to find productive portfolio components. Our measurements of supply and demand show a number of stocks participating in the bull market continuing to shrink. That's a longer-term warning signal, but for now, the move is more to the bullish side than the bearish.
On that note, what is there to look forward to in the third quarter and, of course, beyond? Aside from taper and jitters over the first Q numbers fading, what do you think could be the black swan for 2014?
Nadia, the one that we are watching the most carefully is the geopolitical concerns. They haven't particularly changed our views on global markets. Each conflict we've had so far has been small, self-contained. Geopolitics has been troubling on the margins, but really not worth more than a fret at this point. That may change in the fairly near future, as the discrete events that we've seen so far are creating a rise in the geopolitical tensions. They're all directly linked to what we're seeing in longer term as a creative destruction of the old geopolitical order. It's a process that's gaining momentum, and we're watching it in 4 different areas. Obviously, Russia-Ukraine. The prospect of losing Ukraine was really the last straw for the Russian government. They've been watching NATO enlargement, expanded European economic integration, energy diversification, energy revolution. All are direct security threats that needed to be countered. And Ukraine is also an opportunity for the Kremlin, for Putin to invigorate his flagging support base at home. So that is here and now, and it's probably going to be here for a while. Obviously, Iraq is another one. Iraqi governance could still nominally function well, given the significant American military presence that was there and the military and economic aid that we were getting. Once that was removed, there was little left to keep Iraq functioning as a country. We're watching China. In Asia, it's the consequences and reactions to an increasingly powerful and assertive China. The growth of its influence remains the world's most important geopolitical story by a long margin. But at least today, China's growth is mostly an opportunity for the rest of the world. So we'll be watching that. And finally, let's look at U.S. and Europe. The changing nature of geopolitics is creating a rift between the U.S. and Europe. American global hegemony and had security and economic components. It all was a collective security that had been working very well together as a core element holding together the transatlantic alliance. That's no longer the case, a consequence of changing priorities for the Americans and Europeans, an evolving world order, Russia, Ukraine, etc. Russia and Ukraine really is a major blip, but notwithstanding that, the transatlantic relationship is much less closely aligned on economics. The good news, Nadia, is that none of these risks are likely to have the sort of market implications that the macroeconomic risks did after the financial crisis. There are a lot of reasons for that. Low interest rate environment, solid growth for the U.S. and China. The Eurozone is out of recession. Pent-up demand for investment that's leading to significant optimism. That's not going to be easily turned off by geopolitics. The supply-demand energy story is largely bearish, so near-term geopolitical risks from the Middle East won't create sustained high prices, and markets don't know how to price the geopolitical risk well. So we will see this will result in a lot of volatility, particularly in the energy sector. But this is the one area that the market does not know how and has really not had to add in its valuation. We suspect that's going to become increasingly more important as we go forward.
Midpoint retrospective. Has there been any industries during the first half that surprised you by performing?
Yes, technology, oil-related has done better. Oil-related, bearing in mind that's more geopolitically oriented at this point. We're surprised that high yield and REITs, real estate investment trusts, which are also high yielding opportunities, behaved as well. And we thought that the tapering would have created a transition away from high yielding, but it hasn't. We've been watching growth stocks. They've had a good bull run, but they don't come cheap anymore. So we're watching those, and Walt Disney, Qualcomm, some of the others create longer-term opportunities even before the market starts to transition away from low interest rate valuations. So we are surprised by certain sectors. We weren't as much surprised by the high momentum stocks having a pullback, but it came more quickly than we expected, and so we'll be watching those to see if they can turn around and come with a pullback as opposed to losing more momentum.
In the UK, Mark Carney is trying to cool its housing market with a series of measures. Do you see this as something that's preemptive, given, the subprime crisis that happened years ago, and sort of learning from past mistakes?
They have learned from past mistakes. They're reacting to the current condition based on past history. We think it's probably what he's doing right now is the right attitude for now. Whether or not it's going to work longer term, whether the past history is going to play again, I'm not sure. But they are reacting in the correct manner, not only in terms of the UK, but also relative to what is happening with the rest of the world and the other central banks.
Japan's inflation rate has reached a 32-year high. What was the hottest market following Abenomics is starting to lose steam as its economy is once more faltering? What's your take on this?
We're watching this also. Inflation is expected to slow to around 1% during the summer. I mean, summer is summer, whether it's Japan or here. So we're not surprised at the potential reduction in inflation back to 1%. Also, you have to remember the effects of higher imported energy prices will be reduced because the yen's exchange rate has stabilized. But some of the news that's come out this week, Nadia, that has a potential negative implication. The fact that there are more part-timers being hired than full-timers. Companies aren't really committing to a more favorable long-term prospect when they're hiring part-timers. This, in light of the fact that the population is also shrinking and aging. Job market improvements have been uneven. They aren't across from coast to coast, which is what ABI really needs. They differ by region, by types of employment. So that's a little bit of a negative that we'll be watching. Also, we'll be watching the effects of the faster growth in inflation relative to income to see if the consumer spending, which was a key engine of the first quarter's growth, which was 6.7% in consumer spending, whether the fact that inflation is more than real income growth, whether that will undermine future growth. Household spending fell 8% year over year in May. That was much worse than projected. So this is something we have to watch. But job creation is a key linchpin. The scale of the labor market appears to be expanding despite the declining population. The impressive clip of job growth actually is very positive short term. We just need to see it spread out both geographically and more by industry.
That was Dr. Dolan, Chairman and Chief Investment Officer of Land Infused Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.